Welcome to the Real News Network. I'm Shamini Pires coming to you from Baltimore. Chinese markets have been turbulent since the start of 2016 for several reasons. Days of stock exchange suspensions, the lower yuan against the dollar, the weak factory service sector surveys, and of course worries about looming share sales by major stakeholders once a ban on such sales expires. These are all creating havoc in the market. And with the 7% circuit breaker deactivated late on Thursday, two of China's stock exchanges closed at 2% higher on Friday than it had been doing all week. Let's figure out what happened, its implications for the global markets, and what to expect moving forward. For that, I'm joined by Ho-fung. He is the author of China Boom: Why China Will Not Rule the World. And we are joined also by economist and attorney James Henry. Thank you both for joining us. James, to you, what is it that the Chinese government is trying to do here? Obviously, it's to discipline the market in one way or another, but for what purpose?
Well, let's talk a little bit about what's going on fundamentally. The reason this set of episodes that the professor described is having an impact on world markets is that when the Chinese currency plummets, people around the world are concerned about a contagion of competitive devaluations. And so not only is the economy in China been slowing down, but which affects major developing countries like Brazil and South Africa that have become very heavily dependent on Chinese exports to China. But it's also threatens, to set off a round of devaluations by Chinese competitors like Indonesia or Japan. And so that's why this went from just being a crisis on one stock market, which we know has been a casino, to a global phenomenon. China has a difficult policy problem on its hands. It is trying to so-called rebalance its economy, shift toward more reliance on consumers and household spending, which is only about 40 to 45% of GDP, and to raise household incomes. At the same time, it needs to worry about its massive debt as a fraction of GDP is about 200%. So a lot of people who are not that savvy about China, don't watch it every day, were called all of a sudden to wake up. It's like the Big Short in 2007 when suddenly people woke up and said, hey, let's take a look at those subprime mortgages. Are they real? And people are now, invited to take a much closer look at China, at where all the debt that's been financing its growth has gone. A lot of state-owned companies have done a lot of spending and may be insolvent technically. So this is a wake-up call for the world economy, and it's far beyond this one set of technical mistakes that China may have made with this devaluation.
All right, Ho-fung, what do you think the government is trying to achieve in the sense of these regulations, the 7% circuit breaker regulation, the limiting the actual market activity by who can buy and sell? These constraints were introduced for what purpose?
The government has been trying very hard to stabilize the market. Starting in the late 2014 and spring 2015, when the Chinese stock market was starting to soar, when the bubble was going up, then the Chinese government or many state enterprises and investors in China are trying to ride on the bubble and fan the bubble and fill the bubble, and then many Chinese state-owned enterprise heavily indebted, as James just said, that many of the big enterprise in China is heavily indebted. They're trying to sell their own stocks to pay down some of their debt. So at that time when the bubble was rising, that the Chinese government and many people in China really want to use the stock market to help solve the debt problem, at least reduce the scale of the problem. But after the collapse of the market, it actually it backfired, that many enterprises become more heavily indebted because many
James,
enterprises
comment on that.
speculate on.
The GDP debt rate ratio in China is huge. You were saying offline it's at 200%. Why is this so, and what are the measures to get it under control?
Well, debt has been what's been financing the extraordinary growth rates that China has sustained. But at some point, the debt level now exceeds it. And some people are saying 250% of GDP because some of the debt is not accounted for in the so-called total social financing, but it's at least 200% of GDP. And that is a concern mainly from the standpoint of, there are countries that have had higher debt levels than that without going into a crisis, but it's a concern because if China can't figure out a way to grow without more borrowing, that eventually the debt level goes to 300% of GDP. And at some point, you have a serious debt crisis. That is the longer run problem that's been ignored by everybody who's been speculating in the Chinese market. And just the fact that the stock market rose 135% between June 2014 and June 2015, and then has crashed by 50% in the last 6 months, is just an indicator of how disconnected this stock market in China is from what's going on in the real Chinese economy. So I think you're absolutely right that the Chinese policymakers are trying to get a hold, first of all, over the instability and volatility in the markets. Secondly, to curtail capital flight. And thirdly, to figure out how they can cut interest rates, stimulate the domestic economy, have a $585 billion stimulus package to maintain or accelerate growth, which is declining. And at the same time, not have have their currency freed up so that without having it plummet. So
let's take up this issue of stimulating internal growth in the economy. How are they going to do that with the wages being so low? Let me go to you, Ho-fung, for that. Ho-fung, sorry.
Yeah, I guess it is quite difficult to stimulate the economy right now. The priority of the government is to save the economy from falling further. And as James said, that the debt to GDP ratio is very high, 200%. At some estimated 250, and it's still growing. And in 2015, the debt growth is about 13%, according to some conservative estimation. And the GDP, if we believe in the government figures, it is just 7%. So the debt is growing still faster than the economy. So the debt to GDP ratio is going to grow. And then when it gets out of hand, there only two possible end game of it. One is that many enterprises become heavily indebted, cannot pay back their debt, and then they default, and then it will eventually bring damage to the financial system, and there will be more unemployment and lower consumption because of the unemployment. And then other possibility is that the government use these fiscal resources to bail out and to save many of these companies from bankruptcy. But in such case, then the fiscal position of the central government will deteriorate, and also that many of these saved bailed out company will become kind of a zombie company that has been haunting like the Japanese economy for a while, and then China will be in the longer term of slow growth. So I think at this point the government doesn't have the luxury to talk about pushing up the economy to a rapid growth mode, but to basically to prevent bigger disaster to materialize.
Now, James, one of the conflicts the ruling class here has is that they're very involved in this market, and they're trading in this market, and government corporations also in this market. So it's hard to regulate it against itself, isn't it?
It's a challenge. I think, China's not unique in that situation. We also have an elite that has a hard time regulating itself. And with respect to the banks and the politicians. So I want to emphasize here that China is a major strategic partner for the United States. Nobody should take any joy at the difficulties that China is having. And what we really need to figure out is ways to help China get through this problem, because they are so important to developing countries all over the world. And there's it's a critical investor in the United States, of course, as well, and a critical trading partner. And so, there are many things we can all think about doing with respect to, let's say, the global stock market. Why is it overreacting to events in China on such a massive scale? That's not helping anybody.
And why is it?
How can we collaborate on having reasonable exchange rates here across borders that don't end up in a race to the bottom, competitive devaluations? That would be a nightmare. So, the United States has a positive interest in making sure that China is able to stabilize and return to prosperity here.
And Ho-fung, is there any internal rebellion going on? I know the worker survey is also impacting on the market. And are there workers speaking out, organizing, rebelling against this?
There are reports showing that there's a increase and hike in labor unrest in China. That is actually this trend has been going on for a long time. There's all these wildcat strikes because, and also particularly some exporters got bankrupt and they failed to pay the layoff workers that suddenly find that their employers are gone. So there's a lot of this kind of unrest. And the authorities definitely are very worried about it. So it is why you see the report that the authorities is starting to cracking down on some politically harmless and labor NGOs, people, arresting them that he has been regarded as safe and not threatening to the regime for a long time, but suddenly the authority become very concerned about it. So the government definitely worry about it, and it is definitely this economic situation in the long run is going to find more unrest. And but at the time being, the authorities seem to resort to more repressive approach to prevent this economic turmoil from spreading to become a kind of a major social political upheaval.
Ho-fung and James Henry, thank you both for joining us today.
Thank you.
Thank you.
And thank you for joining us on the Real News Network.